Imagine this. You own a beautiful villa in Thailand, maybe somewhere like Phuket, watching the sunset over the Andaman Sea. And even when you're not there, your property is generating fantastic rental income, really helping you live that dream. It's, well, an idyllic picture, isn't it? But like any smart investment, it comes with practical realities. And today we're diving deep into one of the most critical ones, navigating Thai property rental income tax, specifically for foreign owners. Our mission today is really to cut through any confusion and give you a clear shortcut, a pathway to understanding this essential topic. We're basing this entire deep dive on a really valuable article called Phuket Rental Income Tax Guide for Foreign Owners.
Yeah.
And what's great is where this comes from. Ocean Worldwide, they're a luxury real estate agency based right there in Phuket. And just so we're all on the same page, that's Phuket, pronounced Phuket. They've been operating in Phuket since 2004, focusing specifically on luxury residential real estate there and also in Koh Samui. Plus, their director, Sandra O'Neill, she's apparently helped literally thousands of families and investors navigate these waters over the years. So, this is grounded expertise. Our goal for you today is to pull out the most important bits of knowledge from this material. We want to help you understand the basics, save hassle, stay compliant, even with regulations maybe changing down the line. We'll touch on everything from understanding your core obligations to maximizing your deductions and, yeah, crucially, avoiding those potentially hefty penalties.
Exactly. It's about empowering you, the listener, with the knowledge to make really informed decisions. We want to lay out the tax landscape so you can navigate it, well, effectively and with confidence.
Okay, perfect. So with that in mind, let's start right at the beginning. What are the fundamental tax obligations for foreign owners renting out property in Thailand? Where do you even start?
Well, the first thing to know is how clear Thailand's revenue code is on this.
Yeah.
As a foreign owner, you are definitely liable for Thai tax on rental income from your property. Doesn't matter if it's in Phuket or anywhere else in Thailand. And this holds true regardless of where you actually live or even where the rent payments physically land. If the income is sourced in Thailand, it's taxable in Thailand.
Ah, okay. So it's not about where the bank account is, it's about where the property is.
Precisely. It's about the origin of the income. That's the
Mhm.
key principle. And this leads directly into the concept of tax residency, which really impacts how much tax you pay. Basically, if you spend 180 days or more in Thailand within a single calendar year, you're considered a tax resident. And that means you're taxed progressively. Rates can go into 35% on your worldwide income. So everything, including that rental income.
Wow. Okay. Worldwide.
Yeah. But if you're a non-resident, meaning you're in Thailand for less than 180 days, then you're only taxed on income that comes from Thailand, like the rent from your Phuket villa. And for non-residents, this is often a flat rate, typically 15%, calculated on the gross rental income. So a very different calculation.
That's a huge difference. 15% flat versus potentially 35% progressive on everything.
It is. And just to add another layer, if the property isn't owned by you personally, but maybe through a Thai company you've set up, then it's corporate income tax that applies. That has its own set of rules and rates, potentially up to 20% on the company's net profits. Another really crucial thing to grasp is that rental income falls under what's called assessable income. That's Section 40, subsection 5 of the Revenue Code. Why does that matter? Well, this classification basically confirms it's taxable income and influences how you can deduct expenses against it. It puts it squarely on the tax map. So the big takeaway here is just the importance of being compliant right from the start. Understanding these initial rules is your first step to avoiding, problems and penalties later on.
That tax residency point is so critical. Just to be absolutely clear, if someone genuinely lives abroad, maybe visits their Phuket place for just a few weeks a year, they're definitely non-resident, taxed at that potentially lower flat rate.
Generally, yes. If they're well under the 180-day threshold, they'd fall into the non-resident category, taxed only on the Thai-sourced rent.
And is there a common mistake people make with that 180-day count?
Oh, absolutely. Miscalculating the days is common. People might forget to count arrival or departure days correctly, or they underestimate how multiple short trips add up over the calendar year. The rule is pretty strict. Go even one day over 180, and bam, your status flips to resident, potentially bringing your entire global income into the Thai tax net. It's a small detail with massive implications.
Okay, good warning there. So, we understand the core obligations. Let's pivot to the practical side. How do we make sure we're not paying a single bat more than necessary? How can you strategically lower your taxable income from that lovely Phuket villa?
Right. This is where smart planning really pays off. You essentially have two main avenues for reducing your taxable income from rent. The first is the standard deduction. This is quite straightforward. The Thai system generally allows a standard deduction of 30% off your gross rental income.
Just like that. 30% off top.
Pretty much. It's meant to cover general expenses without needing proof. So if you earn, say, 1 million Thai baht in gross rent for the year, you can automatically deduct 300,000 baht. That leaves 700,000 baht as your taxable income base. Simple, no paperwork needed for the deduction itself. However, the second method, which can often be more advantageous, is claiming actual expenses.
Ah, okay. So if your real costs are higher than that 30%.
Exactly. If your actual documented expenses related to generating that rental income exceed the 30% standard deduction, you can claim those instead. But, and this is a really big but, you absolutely must have meticulous documentation. We're talking proper receipts, invoices, bank statements, anything that proves you actually spent the money on the property for rental purposes.
What kind of things count as actual expenses?
Oh, it can be quite broad. Things like major repairs, fixing the roof, structural work,
Yeah.
also ongoing maintenance, property management fees you pay to an agency like Ocean Worldwide, perhaps,
Right.
advertising costs to find tenants, maybe even the interest portion of your mortgage payments for that specific property. Even things like condo management fees paid to the building's juristic body are typically deductible. Let's use that 1 million baht rent example again. Say your actual expenses were, I don't know, 150,000 for some essential repairs, 100,000 in property management fees, 80,000 for advertising, maybe 50,000 for insurance. That totals 380,000 baht.
Okay, which is more than the 300,000 standard deduction.
Correct. So in this case, claiming actual expenses makes more sense. Your taxable income would be 1,000 minus 380,000, which is 620,000 baht. That's lower than the 700,000 you'd have with the standard deduction.
Definitely worth keeping those receipts then.
Absolutely. It's not just good practice, it's a strategic advantage. It saves you money and makes tax filing much smoother if the authorities ever ask for proof. Meticulous records are key, whichever route you think you'll take initially.
That makes perfect sense. Okay, huge distinction there. Now, let's get into the real nuts and bolts, the actual filing process. What forms do foreign owners need to know about, and what's this withholding tax thing? I hear that term, and it sounds a bit, well, intimidating.
Yeah, let's demystify that. For filing, there are primarily two forms you need to be aware of. First, the main one is the annual tax return, which is called PND 90. This needs to be submitted every year, usually by March 31st of the year following the income year. You declare all your assessable income on this, including, of course, your rental income.
Okay, PND 90, annual deadline March 31st. Got it.
Then there's also potentially a mid-year tax return, known as PND 94. This might be required if you earn significant rental income during the first 6 months of the calendar year.
Mid-year. Why is that needed?
It's basically a way to pay tax on account. It helps spread the tax burden across the year so you don't have one massive bill at the end. The deadline for PND 94 is typically September 30th.
Okay, so PND 90 for sure annually, and maybe PND 94 mid-year depending on income flow.
Exactly. Now, about withholding tax, this isn't as scary as it sounds, but it's very important. It usually comes into play if your tenant is not just an individual person, but what's called a juristic person.
Like a company.
Yes, exactly. A company, a registered business, partnership, etc. If your tenant is a juristic person, they have a legal obligation in Thailand to withhold 5% of the rental payment.
Hold back 5%. Where does it go?
They remit it directly to the Thai Revenue Department, basically as a prepayment of your tax. So, for example, if the monthly rent is 50,000 baht, the company tenant would withhold 2,500 baht, which is 5%, and pay it to the tax office. You, the landlord, would then receive the remaining 47,500 baht.
Okay, I see. So I get slightly less cash in hand each month.
Correct. But here's the absolutely critical part. You must get a withholding tax certificate from that tenant. It's often called a TOR 50 bis form.
Why is that certificate so important?
Because that certificate is your official proof that 2,500 dist of your tax has already been paid for that month. When you file your annual PND 90 return, you use these certificates to offset your total tax liability.
Ah, so you get credit for the tax already paid.
Precisely. Without those certificates, you can't claim the credit. You'd effectively end up paying that 5% tax twice. It's a common mistake that causes major headaches. Always insist on getting those certificates promptly.
Good tip. What about things like rental guarantees? Sometimes developers or agents offer those.
That's a great point. With rental guarantees, which are quite common in places like Phuket, you need absolute clarity in your contract about who is responsible for handling the tax, including any withholding tax. Is it the developer, the management company? Spell it out clearly.
Makes sense. And you mentioned earlier about money landing offshore.
Yes, the offshore payment scenario. It's really important to reiterate this. Even if your tenant pays the rent into your bank account in, say, London or Singapore, it doesn't change the fact that the income was generated from your Thai property.
So the Thai tax obligation remains.
Absolutely. It's Thai-sourced income. The responsibility for declaring it in Thailand and paying the relevant Thai tax still rests squarely on you, the landlord. Don't assume that because the money didn't physically enter Thailand, it's somehow off the radar. The Thai Revenue Department views the source as key, and they do exchange information internationally. Declare it. It's non-negotiable for compliance.
That's a fascinating and incredibly practical point about offshore payments. It really hammers home that tax follows the source, not just the bank account. This naturally leads to another big question. What about getting taxed twice? In Thailand and back home? And for people looking at this more seriously, maybe multiple properties, are there different ways to structure the investment itself for tax reasons?
Excellent question. And yes, double taxation is a major concern for anyone investing internationally. This is exactly where double taxation agreements, or DTAs, come in. Thailand has these treaties with many countries around the world. Their whole purpose is to prevent the same income being taxed fully in both countries.
How do they actually work?
Well, they lay out rules to determine which country gets the primary right to tax specific types of income. For rental income from property, usually the country where the property is located in this case, Thailand gets the primary taxing right. Then, the DTA will typically specify how your home country should provide relief. This might be through exempting the income taxed in Thailand, or more commonly, by giving you a tax credit for the Thai taxes you've already paid, which reduces your tax bill back home.
So you need to check the specific agreement between Thailand and your country.
Absolutely critical. Look for the articles dealing with immovable property or rental income. Understanding how your specific DTA works can literally save you from paying tax twice on the same earnings. It's a huge potential saving.
Okay, so DTAs are key for individual owners. What about that corporate structure you mentioned earlier? Using a Thai company.
Right, moving on to corporate income tax,
Right.
CIT. This becomes relevant if you decide to set up a Thai-registered company to own and rent out the property. It's a common strategy, especially for larger investments or for non-Thai nationals wanting more structuring options. When a Thai company earns rental income, it pays corporate income tax on its net profits.
Is that a flat rate?
It's actually tiered, which can be beneficial for smaller operations. Generally, for most small and medium-sized enterprises, the first 300,000 Thai baht of net profit is taxed at 0%.
0%. Okay.
Then, profits from 300,000 won baht up to 3 million baht are taxed at 15%. And anything over 3 million baht in net profit is taxed at 20%.
So it scales up.
It does. For example, if your company made a net profit of, say, 1.5 million baht in a year, the first 300K is tax-free, and the remaining 1.2 million is taxed at 15%. This tiered system helps smaller companies.
What are the strategic reasons someone might choose this corporate route? Seems more complex.
It is more complex administratively, for sure. But the benefits can include providing a very formal, legally recognized structure. It can also simplify things like inheritance down the line. Transferring company shares might be easier or have different implications than transferring property directly. And potentially, the tax implications when you eventually sell could be different. Selling shares in the company versus selling the physical property might trigger different taxes.
But there are downsides too, right? More admin.
Definitely. Running a Thai company involves ongoing obligations, even if it doesn't make a profit in a particular year. You're looking at annual audits, filing corporate tax returns, maintaining a registered office, possibly director fees, accounting fees.
So it adds costs and complexity.
It absolutely does. It's not a structure to enter into lightly.
Yeah.
It's usually best suited for significant long-term investments, where those benefits clearly outweigh the added administrative burden and running costs. You need professional advice to set it up and run it properly.
That distinction between individual and corporate tax is huge, thanks for clarifying. It's clearly not a one-size-fits-all approach. Now, speaking of specifics, condos are super popular, especially in places like Phuket and Koh Samui, as Ocean Worldwide focuses on. Are there unique tax or ownership things to know just for condos? And, maybe the scary question, what actually happens if you don't comply with all these tax rules we've discussed?
Good points. Yes, condos are incredibly popular, partly because the rules around foreign ownership are a bit clearer than for land and houses. But there are still specific things to know. Firstly, the foreign ownership quota. Under the Thai Condominium Act, foreigners can collectively own up to only 49% of the total saleable floor area in any single condominium building.
Only 49%, so that limits availability.
It can, yes. You need to check the foreign quota status of any building you're interested in. If the 49% foreign quota is full, you generally can't buy a unit freehold in your own name, which leads to the second point, leasehold agreements. When buying freehold isn't possible, or sometimes by choice, foreigners often purchase condos on a long-term leasehold basis.
How long are those leases usually?
Typically, they start with a 30-year term, and often the contract allows for 2 further renewals of 30 years each. So you can potentially secure rights for up to 90 years. You don't own the bricks and mortar forever like freehold, but you have secure long-term usage rights. And of course, everything related to condos buying, selling, renting must comply with the rules set out in the Condominium Act. Oh, and those condo management fees, the monthly ones you pay to the building management or juristic person. As we mentioned, those are generally deductible as an actual expense if you go that route.
Okay, useful specifics for condo owners. Now, the consequences of getting it wrong. What are the penalties for non-compliance with tax obligations?
Right, this is where it gets serious. The penalties aren't trivial. For simple late filings of your tax returns, like missing the March 31st deadline for the P&D 90, you can expect fixed penalties, and these can increase the longer the delay. On top of that, there are interest charges. The Revenue Department charges a surcharge, currently around 1% per month, on any overdue tax amount.
1% a month doesn't sound huge, but
It adds up very quickly. A year late could mean a 12% surcharge, plus the original tax, plus the fixed penalties. It can become substantial. And in more serious situations, like persistent non-compliance over years, or if there's evidence of deliberate tax evasion,
then what?
then you're looking at potentially severe legal repercussions. We're talking hefty fines that can be multiples of the tax owed, the possibility of asset seizure, they could potentially place a lien on your property, and in the most extreme cases, even imprisonment. Honestly, we've seen cases where what started as maybe an oversight or misunderstanding snowballed into major financial and legal problems. It truly underscores why getting it right from the start is so important.
Definitely sounds like something you want to avoid.
Absolutely. Which brings us back to seeking professional advice. Getting tailored advice from a qualified tax advisor in Thailand who understands foreign ownership issues is, well, essential. It helps you navigate all these complexities, stay compliant, and basically avoid all these potential pitfalls. It turns a potentially stressful area into hopefully smooth sailing.
Wow, okay. That was a genuinely comprehensive deep dive into Thai rental income tax for foreign owners, especially with those crucial insights relevant for properties in Phuket and Koh Samui, drawing from that Ocean Worldwide guide. We've really covered a lot from the basics of obligations and tax residency through to strategically using deductions, understanding withholding tax, the importance of DTAs, the corporate structure option, condo specifics. It seems crystal clear that, getting a proper handle on these rules, keeping really meticulous records, and seriously considering professional tax advice, which the source article itself called a lifesaver, it's all absolutely crucial. It really is about making sure your investment in that Thai paradise works for you financially and doesn't turn into, well, a tax nightmare. Being informed and proactive seems key.
Couldn't agree more. And perhaps, as a final thought for you to mull over, when you're considering an overseas property investment like this, think beyond just the numbers, the tax codes, the legalities we've discussed today. Ask yourself, what deeper cultural or socioeconomic factors in Thailand might subtly influence your long-term financial success? Sometimes understanding those local nuances, the market dynamics beyond the spreadsheets, could potentially impact your investment's true value even more than the explicit tax rules themselves. Something to consider.